Hello traders, welcome back to Nova channel and let's continue another new topic today. In today's video, I would like to introduce to you how to trade with a wedge pattern. This is the silent trap that makes or breaks traders. Let's find out now. Most traders lose money not because they don't know patterns, but because they trust them too early. One of the most misunderstood patterns in forex and gold trading is the wedge. At first glance, it looks simple and harmless, but if you don't understand its psychology, timing, and hidden traps, the wedge pattern can quietly drain your account. A wedge pattern is a price structure where the market moves within two converging trend lines, forming a narrowing range. Unlike channels or triangles, wedges often appears when momentum is fading and the market is preparing for a sharp move. Besides that, there are two main types, the rising wedge, which often signals bearish pressure, and the falling wedge, which usually hints at bullish potential. However, the key word here is often, not always. In forex and gold markets, wedge patterns works best on intraday to short-term swing time frames. For scalpers, the most effective time frame are 5 minutes, 15 minutes, and 30 minutes, especially during active sessions like London and New York. On higher time frames such as 1 hour or 4 hours, wedges tend to reflect larger institutional positioning, making breakouts stronger but less frequent. Gold, in particular, loves bombing wedges before news releases or session overlaps, where liquidity builds up quietly before exploding. A proper wedge setup is not about drawing lines randomly. First, price must show clear compression, with each swing high and swing low getting closer together. Volume or momentum usually decreases as the wedge develops, signaling exhaustion. The real trade opportunity does not come inside the wedge, but at the breakout. A high-quality setup happens when the price breaks the wedge structure with strong momentum and closes early outside the trend line, preferably aligned with a higher time frame bias. For forex pairs, confirmation often comes from session flow. A wedge breaking during low liquidity hours is more likely to fail, while a breakout during London Open or New York Open has much higher reliability. For gold, watching the reaction around key levels, such as previous highs, lows, or round numbers, adds another layers of confirmation. However, this is where the most traders get trapped. The wedge patterns is famous for false breakouts. A common false signal occurs when the price briefly breaks the trend line, triggers stop losses, and then snaps back into the structure. This usually happens when liquidity is thin or when traders enter purely based on the pattern without context. Another warning sign is the weak candle closes, long wicks, or no follow-through after the breakout. If the momentum does not expand after the break, chances are high that the move is a fake. To avoid false wedges, traders must combine structure with patience, waiting for a clean close, understanding session timing, and respecting risk management are more important than entering early. A wedge is not a signal by itself. It's the story of the market's hesitation, manipulation, and timing. Those who read the story correctly get packed, and those who rush only defeat liquidity to smarter players. In conclusion, the wedge patterns is not a magical tool, but is a powerful lens into the market psychology. When traded with the right time frame, proper confirmation, and awareness of false signals, it becomes a high probability setup in both forex and gold markets. But without discipline, it quickly turns into a trap. And remember, in trading, it's not about seeing the pattern first. It's about understanding it deeper than everyone else. And that is the topic today. Thank you so much for your watching, and don't forget to subscribe to our channel to receive more useful video for your trading journey. Happy trading and see you in the next video.